All right, let's do a quick update on interest rates, what's happening in the economy, and what you need to watch out for in the coming weeks. All right, before we get started, let's talk about what can cause interest rates to go up or down. If you've asked me this in the past, you know my answer: high inflation, high interest rates. Inflation is the enemy of interest rates, so as we start to see inflation come down, we'll see rates follow. Make sense? On Monday, we received some reports on how other economies are doing right now. One good piece of information that we saw is in Germany, their inflation rate is starting to come down. It came out and it was lower than expected. This is good news since our economies are so global and all tied together so much. What's happening in Germany could translate to a decrease in inflation in the United States. On Wednesday, the Federal Reserve released their minutes from their last meeting in December. Basically, the minutes go over all the topics and everything they talked about during their December meeting. It's nothing that we haven't seen before. The Fed is really pushing to see unemployment rate rise and wage growth slow down, which is really stupid. This is kind of a point of frustration with a lot of people right now because the Federal Reserve printed $5 trillion over the last 2 years. So they pumped in basically 20% of the United States GDP into the economy in the last 2 years. Yep, inflation's definitely going to go up. Then they were so behind the curve when we started to see inflation come up. They said it was transitory. They were 6 months to a year behind. They printed a ton of money, and then they were super late to start changing course to help correct things. Now they want to actively kill the economy because they printed too much money and took too long to realize their mistake. Anyways, on Thursday, we got the latest jobs report, and initially it looked positive, which is bad for mortgage rates. Initially, it looked like there had been 700,000 jobs created, which is kind of odd, especially with what's going on in the economy. But after further inspection, what it actually was is 700,000. The majority of that 700,000 was part-time jobs being created. But the bond market and the stock market, that's why you saw kind of a big sell-off on Friday. Today, we're starting to see that reverse course because they're realizing that was the majority of that report was part-time jobs. On Thursday, we got the latest jobs report. Initially, it looked positive with 700,000 jobs created, which just sounds crazy. The bond market basically sold off and the stock market did poor on Thursday because it looked like there had been a lot of new jobs created. But this was mostly due to part-time jobs. So the majority of that 700,000 created the majority of them were part-time jobs. So this initially made the unemployment rate look a lot lower than it really is. And we saw slowing wage growth for the month of December. So in English, we saw less jobs created, higher unemployment, and slower wage growth. This all sounds terrible, but it's good news for mortgage rates. Why it's good news is because it's showing the Fed that what they're doing with hiking interest rates is working. It's going to lead them to the conclusion eventually that what they're doing is working. It's slowing the economy down. It's slowing inflation down, and they can slow down on the rate that they are hiking interest rates. All right, so next week, this one is big. Next week, on the 12th, we will have the December Consumer Price Index report come out. The CPI report measures inflation. Again, remember, inflation's the enemy of interest rates. The inflation report is super, super important. So on the 12th, that report will come out. Currently, we are sitting year over year with 6% inflation. The predictions, everything that I'm reading is showing that we could see, 5.6% or 5.8%, somewhere around there. If we do see that, that will be really, really good sign for mortgage rates, and we could definitely see the bond market rally, which is a good thing for mortgage rates, and we could see rates start to come down even further. All right, last thing. I'm going to get real nerdy for a second. Take a look at this chart. This chart is of the mortgage-backed security market. So as the chart goes up, rates go down, and vice versa. So at the very end of this chart, you see a big green blob. This is good. This means that the bond market is rallying and that we're starting to see interest rates come down. Why there's that big tick up at the very end of the chart is because basically the revised jobs report showing that most of it was part-time jobs. But the main thing to be aware of is just kind of the overall trend. You can see, back in October is where this chart starts, and we are starting to see the chart, steadily go up. Again, this is good news for mortgage rates. All right, so the second chart is basically the exact same thing. It's just zoomed way out. So this goes all the way back to February of last year. You can see the overall direction going way down. And of course, we saw interest rates go way up this year. But you can see at the end of the chart, there's a lot more activity. We're starting to see it reverse course. All right, so hopefully this was helpful. Hopefully it gives you some context on what in the world's going on with the economy and how that translates into mortgage rates, which ultimately is going to affect home values. Hopefully this is helpful. You can share it with your clients. I'll start trying to do these, once a week, once every other week, whenever some big news comes out, just to keep you all informed on what's going on in the economy. But if you have any questions, drop them in the comments, shoot me a DM, call me, text me. But I will talk to you on the next one, and have a great weekend.